Altria Group or British American Tobacco? Which company is the best stock to have in your portfolio in the tobacco industry? Both offering yields of over 9%. In today's episode, we are going to find the answer to that all-important and question which is asked time and time again in the community. We're going to look at some very important financial metrics and compare side by side which one really is the company to be in your portfolio offering a yield of over 9% and which one can we expect to outperform the other one over the next 5 to 10 years and beyond. We've got a lot of information to look through today. We're also going to compare how they have performed in the past over the last 5 to 10 years. We're also going to compete side by side their income statements, which one has been growing at a faster rate with the better bottom line, which one has a safer balance sheet, total cash versus total debt. Is it Altria? Is it British American Tobacco? We're also going to see what are the institutions doing, which company do they favor to have more in their portfolio. And as always, we will also see which stock is better valued now, and we will run them both through our valuation model to get to our acceptable buy price for both companies to see which one right now offers the highest margin of safety. Now, before we do any of this, we will jump quickly to see Altria's earnings, which did report this morning, as it will give us an idea for the short-term future of the industry. What we can see is Altria Group reported their third quarter results, which fell short of Wall Street's expectations as their demand for core cigarette business cools, and we see illicit e-vapor products flood the market, which takes away the market share of Altria. Now, very quickly taking a look at how they performed. $1.28 adjusted versus $1.29 versus what Wall Street were expecting. On the revenue line as well, $5.28 billion versus $5.43, which was expected. So falling quite short on the revenue and around 1 cent short on the earnings per share. And what we can see that the main point of this was due to the lower net revenues from their smokable products. And this is essentially a 4.1% year over year drop for the third quarter revenue. So not very good by any means of the imagination. And on top of that, they did narrow their guidance for 2023 full year adjusted earnings per share to around $4.91 to $4.98 from $4.84 from the prior year. So not the greatest, and we can see here the Marlboro maker saying their domestic cigarette shipment volume decreased around 11.6%. A few of these reasons which will be also relevant to British American Tobacco, wider declines across the industry as well as that competition from illicit e-vapor products among other factors. So in previous videos I have gone through the bear case for these tobacco companies, regulation as well as a decreasing volume. But today's episode we want to compare which one is the better stock and better valued currently. So year to date, if we start with Altria Group, it is down 12%. We do see it down around 6% today after the earnings report, right there at the 52-week low, offering a yield of over 9%, 9.15% in fact, and investors who have been investing over the last 10 years would have seen around a 7.6% increase on their investment. Now, yes, it doesn't take into account essentially those dividends reinvested, but that is poor by any means. So is this a company that we can invest in today, expecting to see the share price at least double with that yield on cost going into the high teens, 15, 16, 17 yield on cost over time? Now, comparing that to British American Tobacco, that is down even more year to date, around 26.53%. Likewise, at a 52-week low with a high yield, in fact, of 9.5%. Now, those investors who have been holding British American Tobacco over the last 10 years would have, in fact, seen a drop in their share price over the last 10 years of 46%. Very poor by any means of the imagination. So which one of these companies is the better bet over the long term? We are going to get that answer today. Now, looking at their total return year to date, comparing Altria Group versus British American Tobacco, we can in fact see both the losers in their own right, with Altria in fact a loser to a lesser degree, down 6%, and that includes those dividends reinvested, with BTI around 22%. It has taken a huge hit this year. Now, expanding that to the last 5 years, what we in fact see, both companies down, in fact, Altria around 6.6% with BTI around negative 5.8%. So Both very, very poor, but BTI the winner there by a very small margin. And I personally wouldn't even say either one of them are winners. So we're looking over the next 5 to 10 years. Yes, this is historic data and is not indicative of the future, but it is always good to have as one layer of review. Now, looking at their income statements, which one sells the most in terms of their top line and which one has the better bottom line? Well, starting with Altria Group, we have here 19.6 billion reported in December 2018. December 2022, around 20.7 billion. So they have increased that top line over the last 5 years. But what we note is not only is it a very small increase, and you could argue with inflation, it is in fact less. So in real terms, their top line is decreasing. And on top of that, on a granular level, we do see their top line increase year on year up to 2021 before decreasing. So some small inconsistencies there, not the greatest, but we will also look at the last 10 years from BTI versus Mo in percentage form. Now, when we take a look at their bottom line, well, they have 7 billion in terms of the net income in 2018, 5.8 billion in December 22. So they are in fact losing their bottom line over the years. 5 years has gone and it is down by more than 1 billion. And on top of that, on a more granular level, we do in fact see that it has been going in the wrong direction for quite a number of years. So not the greatest bottom line. Now let's compare that to BTI, with we see Altria here around 14 billion in December 22. Well, BTI, their latest in fact was a lot higher, 33.4 billion versus 21 billion. So straight away, they do have a larger revenue on the top line. December 2018, 31 billion. Again, they are also increasing their top line, but to a very small percentage, less than 10% over the last 5 years. And again, they do both follow the same theme where in fact their revenues are inconsistent, with a decrease from 2020 to 2022 for BTI. How does BTI's bottom line net income compare? Well, 7.7 billion in December 2018, 8.1 billion in December 22. So they are increasing their bottom line over the last 5 years, something that when we analysed Altria, they were unable to do, from 7 billion to around 6 billion. With BTI, we see around 7.7 to 8 billion. But do note with BTI, their income, their bottom line is also inconsistent, with a very nice increase from December 2018 to 2021 before decreasing in 2022. So again, there is inconsistencies with both of them, but we do see that BTI is the winner here. They are selling more and their bottom line is also growing and is in a stronger position. Now, comparing it to the health and essential safety of that dividend on the balance sheet, if we start with Altria Group, looking at their total cash, 1.3 billion in December 2018. In their latest quarterly report, 874 million. So they are holding less cash than they did 5 years ago. And comparing that to their total debt numerically and directionally, we see that their total debt, 25.8 billion, roughly the same, 27.2 billion in their latest report. So in fact, it has increased very slightly, but we also see their cash drop slightly. So not the greatest sign, and we'll look at their dividend safety in comparison shortly too. BTI, well, what do we see? They are holding a significant amount of cash more, 3.5 billion in 2018, 5.2 billion in their latest quarterly report. So straight away, they are holding a significant more than Altria. But how does that compare to their total debt? Let's take a look. So their total debt, 60.6 billion. So they are holding a significant amount more of debt than Altria, but they've paid off quite a lot in their latest quarterly report, 53.5 billion. So they still hold more debt than Altria, but they have paid off quite a lot. So rather than losing cash and increasing their total debt, which Altria have done, in fact, BTI are doing the opposite, much better, increasing their cash position while decreasing their total debt. So on a central balance sheet performance and in fact financial performance, so far BTI is the winner. Now, what are the institutions doing? Again, this shouldn't mean what you should copy them, but it is always good to add as a level of research to how institutions are performing. So 59% of institutions hold Altria Group. 5 billion of shares have been sold, in fact, over the last 12 months, although a whopping 55 billion of shares inflows. Shares, in fact, have been bought by institutions. As we can see, Q2, the latest 51 billion worth of shares. And over the period, we can basically see institutions don't tend to really do many buys or sells with Altria. They tend to hold them. And other than Q2, where there was a huge buy, there hasn't really been much movement from other quarters for Altria. So as we can see, 59%. Now comparing to BTI, from the data we have available, around 7.6% of institutions, and we can see roughly the same amount of inflows, 1.4 billion versus 1.5 outflows. So there hasn't been much of a buy or sell in comparison to the other. And another thing we can note, institutions do buy and sell BTI quite regularly quarter to quarter, whereas we don't see much of this when we compare that with Altria Group. So quite interesting, there isn't a clear winner from here. Whether institutions hold or buy shares, it isn't something that we should really be analysing or using within our own research. So now the best thing to do is we jump straight into that all-important financial metrics and comparison to see which one looks like a stronger company for the future. Straight away, British American Tobacco, their dividend safety is 45, borderline safe, and we will touch upon these as we go through. Altria 55, likewise borderline safe, but to a higher safety degree. And we can see the market cap of Altria around 10 billion higher than that of British American Tobacco, but both are large caps, with both yields offering above 9%. Now, these are really key metrics for those that believe we're heading into a recession, so you could argue these aren't relevant given that they were quite some time ago, but it is always good to have that comparative data. We can see in the recession both British American Tobacco and Altria increased their dividends. In terms of sales, there is a whopping difference. British American Tobacco had plus 5% recession sales, with Altria having negative 50%. Now that's very interesting when you consider the recession return of British American Tobacco was worse off at negative 31% versus that of Altria at negative 20%. So you have one company where they had a higher sales, but their return was lower, whereas Altria had a lower return in terms of the sales, but a higher return in the stock market. So that is very interesting, and we'll call that a draw for that analysis. Now, what we can see from here, British American Tobacco's increases have been 1% for the last full year, 4% over the last 5 years, 10% over the last 20 years, with Altria being around 4% this year, 8% over the last 5 years, and 2% over the last 20 years. Now, what I would say is if you're not getting at least a 4% increase on that dividend year on year, whether it's your dividend in fact or your salary or other income producing asset, you are in fact taking a pay cut and losing your purchasing power. Now, the one thing to note here though is because the yield is so high, it'd be one of the companies that I hold where I would say a yield or in fact an increase of 2 to 3% wouldn't be the worst. What we can see, Altria does have a higher recent dividend increase at 4.3% and also the last 5 years at 8%. So I would personally say the winner of this does go to Altria. They have also been paying dividends increasing over the last 50 years or more, making them a dividend king. But again, you could argue that this is irrelevant given the spin-off from Philip Morris, with British American Tobacco at 23 years, meaning they are 2 years away from becoming a dividend aristocrat. Now moving on the analysis to the timeliness, which essentially shows us dividend yield theory. Dividend yield theory says that a company is undervalued when the current yield sits above the 5-year average. As we can see, this applies for both. Both are signaling now to be undervalued. Likewise with the PE, so they are below the 5-year average on both Altria as well as British American Tobacco. And interestingly enough, they are both towards that 52-week low. Do bear in mind though that 52-week low does not signal undervaluation. Likewise, 52-week high wouldn't signal overvaluation. Now, earnings payout versus free cash flow. This is quite an important one. Earnings for both I tend to ignore, but it is there if you want to see it as an investor. It is susceptible to manipulation by management through accounting. So we focus on the free cash flow. The reason for this, for example, in 2016 for Altria, you would look at the earnings and say it's below 80%. It's fairly positive. But we see 126% on the free cash flow. This suggests, or this shows in fact, management are paying out more in dividends than they are generating in free cash flow. So looking at from the more recent times, in fact, for British American Tobacco, it has been below 60% over the last 5 to 6 years, with 2023 still expected at 58%, so below 60. Below 60 is personally what I look for in stocks. Why? Well, personally, I believe it to be that management have the ability to offer those double-digit dividend increases. But with tobacco industry, given the yield is already high, I am happier with a higher payout ratio at around 80%. So with Altria over the last few years, it has been around that 80%. But what we can see, 2023 expected 84. So if I was speaking in terms of the free cash flow payout, I would say that British American Tobacco is the clear winner with a significantly lower payout. But it is interesting when we do look at that dividend safety, that British American Tobacco has a lower safety score, and we will touch upon that shortly. Now, earnings per share data for both companies available there, but I will focus your attention on the free cash flow, as earnings, as mentioned, is susceptible to manipulation by management through accounting, so I will analyse their free cash flow. 195 for BAT, 432 in 2022, so more than double over the last 10 years. Yes, it is essentially inconsistent. It is an increase on increase year on year, as we can see relatively flat from 2015 to 2017, but in my opinion, it is still very strong that it has increased over the last 10 years. Altria Group, a very similar story, more than 2 times increase on the free cash flow, 212 to 502. So again, very positive to see. Both are increasing those free cash flows by more than double over the last 10 years. Now, sales growth, one area, if you've seen the previous videos of stocks that we've analysed in the tobacco industry, they do find it hard to increase those top line. The reason for that, with volumes decreasing, they're having to increase their prices, and consumers are either not buying more products if they're seeing the price increase beyond what they can afford, or moving, as we saw, to illicit products, as Altria saw over the recent quarter. So what we can see for both of them, they do struggle with the top line. With Altria, they have consistently had positive other than 2022, with BAT around negative from 2013 to 15. And in terms of how much they've increased on the top line, well, BAT has gone from around 15 billion to 28, so nearly doubling their top line. With Altria, slightly lower from 17.7 to 20.7 on the top line too. As we can see, neither are really increasing at above inflation year on year consistently, which would be around 4% or more. Now, shares outstanding, there's a clear winner here. Altria Group, they do share buybacks, even if they are very small, having bought back around 200 million of shares over the last 10 years, returning excess cash to our pockets. Whereas with British American Tobacco, we see in fact the opposite, 1.91 to 2.27. They issue shares and dilute your position as a shareholder. So this clear winner for shares outstanding goes to Altria. Now, ROIC, one of my 7 golden dividend metrics. This is very important. One of my favorite metrics to look at for a company. 10% or more is what I look at. It means management are able to effectively allocate their capital. There is only really one winner here. Altria, well above the 10% I look for, and well above 20% consistently year on year. The last few years in the 40s, whereas British American Tobacco from 2017 haven't managed to get it above 10%. So this is one negative metric for British American Tobacco. Now, operating margin, free cash flow margin, a very similar story with both companies. British American Tobacco, consistent operating margins around 40%, with Altria nearing around 50%, so they do have the higher margins. And on the free cash flow margin, a very, very close call, with both companies producing some very strong free cash flow margins. So very, very positive for both companies on this aspect. Now, one area which is slightly tricky and does correlate to that dividend safety that we saw earlier, the net debt to earnings before interest, tax, depreciation, and amortization, essentially signaling the number of years that it would take a company to pay off all of their debt net of cash on hand. Below 3 is what we look for, and with British American Tobacco, it has been higher than 3 consistently for the majority of the last 10 years, although 2022 at 2.96 and 2023 at 2.91. Comparing this to Altria, what we see is it's been below 3 consistently over the last 10 years, and in fact declining from 2018 below 2 at 1.85 in 22, and expected to be 2.12 in 2023. Therefore, we see some very, very strong differences with Altria having this under control, and therefore, if I had to have a guess, I do have more faith in Altria's over 9% dividend than we do at British American Tobacco. Now moving on to the valuation. If we jump straight into Altria Group, and what we typically do is we run through each valuation model as we have here. We have our 4 valuations: Graham's valuation, multiples valuation, the dividend discount model, and then the DCF model to get to our intrinsic value. So for today's purpose of time, we will jump straight into the valuation numbers. And as always, if you are enjoying the content as we go along, do click on the like button and do hit that subscribe and bell button so you continue notified of these videos. So the intrinsic value that we got for Altria Group was around $55.53. And as we currently see, the current price is around 40.39 cents. Margin of safety, we would typically start with 10% if you believe it has a wide moat, strong financial metrics, and good forward-looking data. With Altria, we would go a lot higher depending on your margin of safety as an investor. What we can see though, right now, if you were to lock in around at $41, you would be getting a margin of safety of 25%. 30% would be slightly lower at around $39. So when we're comparing the two stocks, currently right now, Altria Group is offering a margin of safety of 25%. And we can see Wall Street do see around 20% upside to the current trading price. When we compare that to the upside of BTI, and as always, if you do want to grab a copy of this model to run companies of your own into this intrinsic value to get your own acceptable buy price, do click on the pinned comment below. We're getting a $64 intrinsic value for BTI with the current price around $29. So the margin of safety, typically 10% as I mentioned, but for this industry, the macroeconomic conditions and regulation fears coming in, you would expect a much higher margin of safety. Right now with BTI, you would be getting up to a 50% margin of safety based on the estimates and judgments we run through to get these figures. But with Wall Street, what they are expecting is around $50, so they are also expecting some nice upside onto the current price. So in comparison with BTI and Mo, with Altria right now, you are getting, as we just ran through, a 25% margin of safety, with Wall Street seeing around 20% upside to the current trading price. With BTI, you are getting a much significant margin of safety at around 50%, with Wall Street expecting a higher upside than they do with Mo right now. So it really depends. Which is the better valued stock right now? In my opinion, it would have to be British American Tobacco. Which is the better stock to have in your portfolio? Well, personally, I would say Altria Group. The reasons for this, as we ran through when we looked at those financial metrics, as we can see, one of the most important metrics is that net debt to EBITDA. As we can see, Altria's is significantly lower. And the other metric that was very important when we were analyzing this is that return on invested capital. Altria does have a much higher return on invested capital. Now, as always, we do see these different figures that we run through, and everyone has their own essential judgments. So do let me know in the comments below if you are looking to add either of these, sell. Even if you're on the sideline speculating, let me know if you agree with the analysis in today's video. And as always, do hit that like if you enjoyed the content and want more. If you have any other duopolies you want me to compare, do put them in the comments below. And don't forget to like if you've enjoyed the video. It really helps with the content and getting this community to expand constantly. And do hit that subscribe and bell button if you want to be continually notified of these videos and have them dropped to your doorstep. If you want to jump and join us in the Discord talking all things buys and sells in the market, do click on the pinned comment below. We'd love to have you in the Patreon. And if, as always, you want to jump and buy this valuation model to get your own intrinsic value, to get your own acceptable buy price, whether it's companies that we've run through or companies in your own portfolio, do click on the pinned comment below. As always, have a great day. Catch you on the next episode. Thumbs up, like, drop some comments. Catch you later. Take care.